Trump's tariffs aren't the only thing making other countries nervous. His pro-crypto policies are also causing panic, and that's because crypto, especially US dollar stablecoins, could undermine their national currencies. And this is why the European Central Bank, or ECB, has been doubling down on issuing its digital euro, with some reports claiming it could launch as soon as October this year. And chances are that we'll see many other countries follow suit. And that's why today we're going to bring you up to speed on what's been going on with the digital euro, reveal when it could launch, and why an alternative could come sooner. My name is Nick. Stay tuned. Let's start with a quick recap. According to the Bank for International Settlements, the so-called Bank for Central Banks, almost all the world's central banks are exploring central bank digital currencies, or CBDCs. CBDCs will make it possible for central banks to control how you save and how you spend your money. This is not a conspiracy theory. It's a direct quote from Augustin Carstens, the managing director of the BIS. In a now infamous presentation, Augustin said that central banks would have, quote, absolute control over how CBDCs are used, with the details of these controls revealed in CBDC reports they've written. And if you've been keeping up with our coverage of CBDCs, you'll know that central banks have discussed things such as limits on holdings, limits on spending, using CBDCs to replace physical cash, and even using CBDCs to replace gold. And many of these proposals came from CBDC papers written by the ECB. And this is terrifying because, in contrast to other central banks, the ECB's monetary policy is not limited to things like inflation and unemployment. It also includes things like the environment and ensuring the stability of the euro as a currency, something that's difficult to do given that it's used by so many countries. And this means that there's a high risk that a digital euro could someday be used to do things like restrict how much you can travel and restrict how much can be saved or spent in one EU country versus another. Recent comments by top EU officials, including ECB President Christine Lagarde, about using savings of citizens to fund the EU's military and environmental policies sound pretty scary in the context of a digital euro. A digital euro could be used to put negative interest rates on European savings accounts, something that has also been discussed in CBDC papers. This would basically force Europeans to invest that money in other things, such as the green bonds issued by the EU, to ensure that their savings maintain their value. At the same time, it could ensure that they can't invest this money in other assets and currencies. It doesn't help that Christine confirmed in a 2023 interview that the digital euro would be controlled. But how did we get here? If you've been keeping up with our coverage of the digital euro, you'll know that the ECB and most other central banks have been interested in CBDCs since 2019. And that's when Facebook announced its digital currency called Libra. The central banks around the world instantly realized that a digital currency launched by a social media company could undermine their national currencies. In the ECB's case, it was the 2021 crypto bull market that pushed it to start working on a digital euro. The massive crypto rally must have been a wake-up call that crypto adoption was real and growing fast. It's funny to think that some ECB officials probably lost sleep over thoughts of a crypto supercycle. Anyways, in 2022, the ECB published a few preliminary papers about its digital euro, some of which included the seriously dystopian stuff I mentioned earlier, phasing out cash, replacing gold, and so on and so on. And these papers even referred to commercial banks and payment processors as, quote, monopolists. By 2023, however, the ECB had softened its tone, and this was partially because they realized they needed commercial banks and payment processors to make the digital euro work, and partially because the public perception of it was so abysmal due to the ideas the ECB itself had proposed earlier. The ECB also made minor changes to the design of the digital euro, meant to give the impression that it's less dystopian than it really is. The best example here is conditional payments, which are identical to programmability, but are implemented by commercial banks using tools the ECB provides, thereby absolving them of responsibility if things like emissions and location limits are implemented. Anyhow, since late 2023, the ECB has been in the preparation stage for the digital euro, and this stage involves finalizing its design and partnering with any financial institutions necessary to launch it. Contrary to popular reports, the digital euro will not launch in October 2025. Rather, its final form will be revealed to EU politicians, who will then vote on whether to implement it or not. By the way, if you're finding this information helpful, then let us know by smashing that like button. And if you're not subscribed yet, you can hit that subscribe button down over there, and you may as well hit the bell as well to make absolutely sure you don't miss our upcoming content. Back to the video. Now, our last digital euro update was last summer, and if you watched that video, you'll know that the whole CBDC dystopian narrative isn't as clear-cut as it seems. From the ECB's perspective, cash use is going to continue to decline regardless of whether the ECB does anything or not, which is probably true. The ECB doesn't like this because cash is technically the only form of money in Europe that's issued by the central bank. In other words, cash is the only form of public money. All the other money, the digital money, is technically private as it's issued and managed by commercial banks and payment processors. As their digital payments continue to gain ground, the influence of the ECB will continue to wane. And this creates two problems. The first is that most of the financial system in Europe could eventually be controlled by commercial banks and payment processors, most of which are not based in Europe. And the second is that it will make it harder for the ECB's monetary policy to affect the EU. And you'll recall the need to control monetary policy is high for the ECB, given that so many different countries use the euro. In the ECB's view, there's only one solution, and that's to launch a CBDC, the digital euro. And this is why the ECB often refers to the digital euro as a digital cash. It is technically correct because the digital euro is a form of money issued by the central bank, just like cash. However, it's different from cash for reasons we've discussed earlier. The digital euro gives the ECB surveillance and control over all transactions. Again, the ECB has tried to sidestep this fact by outsourcing most of these controls to commercial banks and payment processors. But the ECB is the one that regulates these entities. And this means that even though the ECB is not directly in control of the digital euro per se, it can easily exercise control indirectly through the regulations on the financial intermediaries that will act as the front ends for its users. That said, the ECB is planning to launch a digital euro app as well as physical debit cards that will make it easy to buy, sell, and send. Otherwise, the digital euro will be accessible via most banks and payment processors. As we've mentioned in our previous videos, it will literally just be another tab in your bank account, but could actually someday be the only tab if the EU and the ECB get carried away. Strictly speaking, though, the ECB will only handle the issuance and redemption of the digital euro. Everything else will be handled by commercial banks and payment processors, with the ECB providing the tools for them to do this. Before that, though, the ECB needs to provide them with a rule book that provides all the details about how the digital euro works, how it will be minted, redeemed, and so on and so on. The last update about the digital euro rulebook was published earlier this month. It reveals the most recent version of the rulebook received a staggering 2,000 comments from financial intermediaries, and these comments will be addressed in a new version of the rulebook expected to be published in Q3. It's not entirely clear when the final version will be published, but the goal is presumably by October 2025. And this is more significant than you think, because it essentially means that nobody knows exactly how the digital euro works, at least not yet. Objectively speaking, this makes it very difficult to support or reject its implementation, and I'll reiterate that it's become less and less dystopian as time has gone on. In fact, it's gotten to the point that the ECB is open to allowing offline peer-to-peer transactions using digital euros that are completely anonymous, at least up to a limit. Of course, nobody knows what this limit is, and obviously all those anonymous transactions will be visible the moment you're back online. But the fact is that as more time goes on, the more watered down it becomes. At first glance, you might think this is because most Europeans have no interest in adopting the digital euro, even according to the surveys conducted by the ECB. Upon closer inspection, however, you realize that its biggest opponents are not libertarian-minded Europeans, but the big banks.
The Coin Bureau Deals page. It won't make you stronger, but it will make you better at crypto.
And this is where things get Interesting. As some of you know, the ECB is explicitly looking to put a limit on digital euro holdings, and I'll repeat that the exact limit is up in the air. Contrary to popular reports, this is not to restrict Europeans from spending, but to prevent the banking system from collapsing. And that's because if there's a crisis of some kind, it's believed that most Europeans would swap a lot of their regular euros for the digital version. And that's simply because they would be safer to hold than regular euros, since the former are owned and operated by the ECB and the latter by commercial banks. The practical effect of this would be central bank reserves being drained, potentially triggering a banking crisis that causes the banking system to collapse, kind of like what we saw in the US in early 2023. Again, it seems that the ECB wouldn't mind the big banks going under, but even they understand that they need the big banks to handle all the onboarding, offboarding, and help for digital euro users. In any case, this is not only why there's going to be a limit on holdings, but also a waterfall function, wherein any digital euros you receive above the limit will be automatically converted to regular euros in your bank account to preserve bank stability. And what's fascinating is that the ECB has considered applying the waterfall function to all corporate digital euro inflows, meaning their holding limit would be zero. On that note, the ECB wants to make digital euro transfers free for users, but still have merchants pay fees when receiving a transaction, the same way they do now with card payments. The catch is that the fee will be lower and there will be a limit to ensure merchants don't get squeezed. In theory, this will make the digital euro a preferred payment method among merchants in Europe, as it will be a cheaper alternative to existing card payments provided by banks and payment processors. In reality, however, merchants may not adopt it, even if it becomes a legal tender. A member of the ECB explained in a Q&A last year that this is because of Europe's legal tender laws, which effectively make it legal for merchants to reject certain forms of payments, even if they're a legal tender, such as cash. Given that digital euros are technically digital cash, there's nothing stopping merchants from rejecting these payments too, at least according to existing laws. And this ultimately depends on how lucrative it will be for merchants to accept the digital euro. If the fees are substantially lower than existing card payments, many merchants would probably accept it as a payment method. Even so, that doesn't mean that consumers would start paying in digital euros. As that same ECB member explained, it's not possible to force someone to do something even if it's mandatory. And this is something we've underscored in many of our videos about dystopian technologies like CBDCs and digital IDs. Sure, you can force people to create a CBDC wallet or create a digital ID, but you can't force them to use these products in their day-to-day activities. The only way to do this is to incentivize them to use the digital euros. But as we just learned, it's dangerous to provide too much of an incentive, because if too many people start holding digital euros, it threatens the stability of the banking system. And that's why the ECB has repeatedly stated that digital euros would not provide remuneration, meaning that you won't be able to earn any interest rates on your holdings. With merchants and consumers both having very little incentive to hold or use digital euros, it's hard to see how they would ever gain ground as a payment method within Europe. Even that ECB member admitted that the dominance of public money will be lower in 20 years' time, even if a digital euro is launched. And this is something that we've highlighted in our previous videos about CBDCs, and that's that they fail to address the fundamental reason why people are switching to private forms of money. Most publicly issued money sucks because the government, which backs these currencies, have taken on too much debt, and the central banks, which manage these currencies, have done a bad job of doing so. And this brings me to those two big questions. When will the digital euro launch, and why the alternative could be much worse? To recap, it will not be launching in October 2025. That's just when the ECB expects to complete its preparation phase. After that's done, EU politicians will have to vote on its approval, and that reportedly takes at least 2 to 3 years. This means that the digital euro may not be launched until late 2027 or late 2028, and that assumes that EU politicians vote to approve its launch. It's not currently clear how many EU politicians are in favor, and that's mostly because the design of the digital euro hasn't been finalized yet. Fortunately or unfortunately, the final version will likely be so watered down that it won't be a threat to anyone, even if approved. And this begs the question of what the alternative could be and why it could come sooner. Believe it or not, but the answer could be stablecoins, specifically euro stablecoins. Right now, stablecoins are backed by government debt. In the case of euro stablecoins, they're backed by European government debt. In the future, however, it's possible that stablecoins will be backed by commercial bank deposits or even central bank reserves. As a fun fact, the latter is referred to as hybrid CBDCs, and it's something that's been discussed by the World Economic Forum in reports we've previously summarized on this channel. From our perspective, hybrid CBDC systems could come much sooner than actual CBDCs. And that's because the government debt that backs stablecoins is becoming increasingly volatile because of the relentless spending by governments around the world. If this trend continues, the chances of a stablecoin depeg will rise, as the collateral backing the stablecoins will be harder to liquidate in size to honor redemptions. This risk is acute in the EU, where many government bond markets are illiquid. And this foreshadows a scenario where a euro stablecoin depegs because the issuer cannot liquidate the European bonds back in the euro stablecoins at a price that's high enough to honor the stablecoin redemptions. If this were to happen, then it would likely result in a change in stablecoin regulations that mandate them to be backed by commercial or central bank reserves, creating a hybrid CBDC. To be clear, it doesn't look like this will happen anytime soon, but it could happen much sooner than a regular CBDC launch. In case it wasn't clear enough, a hybrid CBDC would be no different from a regular CBDC to all intents and purposes. It would still be possible to set limits on spending, limits on holdings, and all other qualities that make CBDCs seriously dystopian. In fact, the same is true for most crypto stablecoins right now. What this means is that if stablecoins win against CBDCs, we could practically end up in the exact same dystopian financial system, just with different entities pulling the strings. In fact, you could argue that a stablecoin-based system would be worse because there would be no way to change it unless you're an executive at the stablecoin issuer, and even then, you probably answer to your largest shareholders. Not only that, but it's quite possible that we could actually end up with an actual monopoly of stablecoin issuers, just one or two companies issuing stablecoins for all countries globally. And this would look eerily similar to a single global CBDC system that many people in crypto are opposed to and claim to be fighting against. To be blunt, a global system consisting of multiple CBDCs would probably be less dystopian than a global stablecoin system consisting of one or two issuers. Consider that in a multi-CBDC system, you could still move to another country if you don't like the policies of the central bank. That probably won't be possible if we end up in a global stablecoin system consisting of one or two issuers. Food for thought. And while you're thinking about it, you can check out our video about how stablecoins could solve the US government's debt problem right over here. And if you're not subscribed to the channel yet, you can do that right over here. That's me for now. Thank you very much for watching. Nick out.